Hello, everyone. I am Katie Kalmahi-Eva with Sterling Seacrest Pritchard. Thank you for joining us today. Sterling Seacrest Pritchard is a risk management and insurance brokerage firm serving the commercial, professional, and personal needs of clients across a range of industries. We are happy to offer free educational programs to our clients and network each month, and we're excited about our program today, an educational crash course on Secure Act 2.0. We have Jaime Benedetti and Chris Cristallo of Benedetti, Gucer and Associates here to tell us everything we need to know about the Secure Act. Jaime is a wealth advisor and managing principal at the firm, and Chris is a qualified retirement plan advisor. Benedetti, Gucer and Associates is a boutique wealth management firm. They offer wealth management, business owner services, legacy planning, and retirement planning services. We'd like to hold all questions until the end of the presentation. We would love to hear from you, though, so if you have any questions or comments, please feel free to submit them using the Q&A chat feature, or you can unmute yourself at the end of the presentation. All right, Jaime, I'm ready if you are to kick us off.
Sure. Well, thank you, Katie. Chris, if you want to kick the slide forward, I'll just start out by maybe telling you a little bit about our firm. These were the intros that Katie just gave. And one thing that is really important that I think is worth pointing out is that while we are a full service wealth management firm, we do specialize in qualified retirement plans. This is distinct. We have a division that Chris and myself head up that focuses exclusively on retirement plans. That is not the norm. I probably don't need to tell most of the people on this call that a regular financial advisor and a retirement plan financial advisor are sort of two different animals. It's like an orthodontist and a dentist. There's a lot of overlapping knowledge, but it is a niche within a niche. And so we do specialize in plans. We do a lot of plans all over Georgia and all over the country. I'm going to talk a little bit about our mission and our values. I know this sounds kind of fluffy, but I do think in the 401k space, this is actually pretty important. We view our role as simplifying the lives of our clients and bringing them financial peace of mind. And within the 401k space, there's a lot of different players involved. And most of the time, the client doesn't really understand whose responsibility is whose. And so what ends up happening is the buck gets passed a good bit. The TPA will say, well, that's not my responsibility. That's on the advisor. I don't do the investments. And then the advisor will say, well, that's not my responsibility. That's the record keepers. And in any one of those scenarios, that individual may be right. The client may be coming to them for something that is outside their scope of services or their responsibility, but that doesn't make it any easier for the client. We really view our role and our value add as stepping in and fixing those problems, even if it's not our responsibility to do so. So either going above and beyond, doing something that's not really our job, or just helping the client hold people accountable. So we take great pride in that. And Chris, if you kick it to the next slide. So again, I mentioned our mission is to simplify the lives of our clients and bring them financial peace of mind. We do that through our 3 core values of service, integrity, and knowledge. We have a lot of other values that are important to us, but we feel like to really execute on our mission statement, you got to have these 3. And we have what we call 2 bonus values, humility and generosity. Humility, we sort of see it as the mother virtue. You can't be service oriented if you don't have some degree of humility. It also helps small mistakes not turn into big mistakes. I think you need humility to have integrity, because oftentimes that means doing something that is not in your best interest, but is in the best interest of the client. And then I think you do need humility to be knowledgeable, because you also have to kind of know the bounds of your knowledge and know when you need to bring in someone else. And then generosity is another value that's important to us, but we don't see it as core to executing on our mission statement. So that's a little bit about us in a nutshell. Now we're going to get to the fun part and talk about Secure Act 2.0. Oh, and by the way, we've got two core office locations, one in Atlanta, one just outside of New Orleans.
All right, great. Thank you so much for that introduction, Jaime. So with today's agenda, we'll start with giving everyone a little bit of a background on the Secure Act 2.0 and talk about how it came to place. Then we'll talk about the provisions and highlight which ones of those are mandatory and which ones are going to be optional. So the Secure Act 2.0 was big news for companies that were on the fence about sponsoring a retirement plan. And we'll go over the provisions that were put into place to entice those types of companies to sponsor a retirement program, things like tax credits and special incentives. Then we'll talk about what we're hearing around the industry in regards to how plan sponsors are viewing the legislation. And then finally, we'll take a closer look at the rollout timeline. So a little bit of a background, the Secure Act 2.0 was passed back at the end of 2022, and we really have been talking about a major legislative change for what feels like years now, and it finally came into fruition in 2022. So Washington did want to ease the burden of implementing certain provisions in the Act. So it does contain a combination of immediate and phased-in provisions that will be implemented over the next few years. That being said, with all the gridlock and partisanship that we've seen in Washington recently, it certainly is refreshing that a major thing was passed and put into law. So the Secure Act 2.0 coming in at over 92 provisions and even more pages than that. The Secure Act 2.0 was one of the biggest retirement legislations that we've seen in recent years. Now, don't worry, everyone here, I won't bore you and go through provision by provision. However, I will select a few that I think will have the biggest impact in that plan sponsor landscape. While certain provisions within the Act must be followed as they are required by law now, there are also additional provisions that are flexible for plan sponsors. So it's important for plan sponsors to evaluate these provisions to see if they fit your organization or your ultimate plan goals. So the Secure Act 2.0 can be really complicated. Think about the number of provisions. Some of those provisions are optional, while some of them are mandatory, and some of those provisions are immediate, and some of the provisions are phased in. But our real goal today is to help you cut through that noise and help you better understand how you and your peers are considering and ultimately prioritizing these provisions in the Act. Right now, there really are a lot of balls still up in the air, and plan sponsors, and maybe even more importantly, record keepers, are in the initial stages of seeing how some of the provisions within the Act will ultimately play out. So jumping into some of the most important provisions that we've seen, the first one being Roth catch-up contributions. So in 2024, any participant 50 years or older who makes more than $145,000 or more that wants to make a catch-up contribution to their retirement account must make those contributions on a Roth basis. So no longer can someone who makes over 145 or more make a traditional catch-up contribution. They must be Roth. Another really key point on this provision is that the plan must have a Roth feature written in the plan document in order for these catch-up contributions to be made. So really important here, a little homework assignment for everyone here on the call. Please take a look at your adoption agreement. Go look at that plan document. Make sure that your plan allows Roth contributions, because if it doesn't, after plan year 2024, participants will no longer be able to make catch-up. So you need to get that provision in place if you don't have it already.
And just for clarification here, again, what we're referring to is a specific catch-up component for somebody that is over age 50. Prior participants had the option of choosing whether to make that a Roth or a traditional tax-deductible contribution.
Yep, definitely. Great point there, Jamie. So the next point is the increased catch-up contributions. So for this one, individuals who are age 60 and over are allowed to start contributing more into that catch-up contribution bucket. So they increased the number up to $10,000, moving it up from $7,500. So participants who are under the age of 60 after in plan year 2025 still have the option to make that $7,500 catch up. It's just individuals who are 60 and older get that additional bump in saving. Another really important provision here is that now employer contributions can be treated as Roth. So starting immediately, they can be treated as Roth, and they do not need to go into the plan on a traditional basis. So think about things like profit sharing, safe harbor contributions, non-elective contributions, things like that. In the past, they would have to be in that traditional bucket, but now if the participant elects, they could be treated as Roth moving forward.
Yeah, and then just to sort of restate that and maybe clarify a little bit, Roth contributions, you don't get to deduct them and they grow tax free. Traditional contributions, you get an immediate tax deduction, they grow tax deferred, and you pay taxes when you pull it out. And as Chris mentioned prior, the only contributions that you could elect as Roth versus traditional were participant contributions, meaning the participant had to defer their salary, whether it was just salary deferral or whether it's a catch-up contribution because they're over a certain age. They had the option to select, do I want this to be taxable and grow tax-free, or do I want a tax deduction and it grows tax deferred? But everything the employer put in, the match, profit sharing contributions, all of that had to be tax deductible. It could not be Roth. And so that's changing now.
So the next provision.
So sorry, one other thought there. That doesn't seem like a big deal, but if we think about when would that be significant? Well, if an employer has a very young workforce, like let's say it's a lot of the rank and file employees are in their 20s and 30s, you could make a case that broadly speaking, Roth contributions would be more valuable to them because they're younger. That contribution is going to be in the plan longer, and it's going to have more time to grow and be a tax-free benefit. Whereas an employer who, let's say, has an older workforce, maybe in their 50s, where they're in their peak earning years, they're probably all high earners, a traditional contribution might be better because they get to deduct it and they're in higher tax brackets. Same thing if an employer has a workforce that is relatively low income, like a blue collar workforce where they're all in low tax brackets, getting that tax deduction probably isn't as beneficial to them as having that money go in as a Roth and grow tax free for the rest of their lives. So again, it's the type of thing that understanding these rules and giving the employer guidance can help them really increase the benefit to their participants.
Great points there, Jamie. Thank you. So another provision, while taking a withdrawal from your 401k account can really dramatically shrink your retirement savings, the Secure Act 2.0 does offer some provisions to accommodate, let's say, some employees that might be in sort of financial strain. The first provision is what's known as a plan-linked emergency savings account, otherwise known as a PLESA. This allows non-highly compensated employees to save Roth dollars up to $2,500 as sort of like in an emergency savings account. Withdrawals from that PLESA account, including even earnings, are tax-free and are not subject to a 10% penalty tax on early withdrawals. So interesting provision there. Also beginning in 2024, participants may be able to receive one distribution up to $1,000 per year for emergency purposes. And employees have the ability to self-certify, basically tell you guys, the plan sponsors, that they meet the requirements for that distribution based on an emergency. And also that distribution would need to be repaid within 3 years. So again, just another way for participants to get early access to their money without paying that 10% penalty that they had prior to the Secure Act 2.0. And these two provisions here are not one of the mandatory ones. These are optional. So they would require a plan amendment to get it in place. Another really interesting one, starting in 2024, qualified student loan payments would be considered as 401k deferrals for the purposes of matching contributions. This means that employees who have student loans and are making payments on them regularly can allocate their student loan payments towards the 401k plan and receive matching contributions based on the amount of dollars going to the student loans. That's a pretty interesting provision there, right? Again, this really is beneficial for the younger workers in your company. Let's say they can't afford to contribute to the 401k plan and pay their student loans. They would now have the ability to make their payments on the student loans and also receive company match, which I think is pretty powerful. One mandatory provision, the delayed required minimum distribution age. So effective immediately in 2023, the age at which individuals are required to start withdrawing their money from the plan will be raised to 73. And then also 10 years from now in 2033, that number will go up a little bit more, increase to 75. The IRS, the Department of Labor, ERISA, they all do really recognize that people are starting to live longer and are going to need this money for a longer period of time. So that's why they're kind of pushing that number, kicking it down the road a little bit, and make it older and older before you need to start withdrawing from the 401k plan. Also, starting this year in 2023, there have been some changes in the requirements for the annual notices that need to go out each year. This is especially powerful for unenrolled participants. Before the Secure Act 2.0, unenrolled participants really had to receive most notices, even though they chose not to participate in the plan. But the new regulation really no longer mandates that we need to include them on those regular distributions. So ease the burden a little bit for plan sponsors. I know that notices could be a little bit of a pain point usually, but this eases that burden a little bit for all of us. Also in 2024, the automatic rollover for terminated participants will increase by $2,000. So right now in 2023 in the past, that limit was $5,000. The IRS is going to bump that up to $7,000. So if a participant has $6,999 in the plan, we would have the ability in 2024 to roll that participant out of the plan and into an IRA account.
And again, maybe chiming in here just on some practical applications. When is this significant? Well, if a plan has more than 100 participants, it requires an annual audit. So for plans, and the rule's a little bit more complicated than that, because if you've got less than 120, you can essentially do what you did the prior year. But so for plans that are in that range, that have right around 100 participants, and let's say they've got 10 or 15 participants that aren't employed there anymore, but still have plan balances, that counts towards that limit. And so this cash out option can be really powerful, because for a plan that's on the cusp, if an employee has less than that dollar amount, right, which right now is $5,000, you can force them to roll their money out, get below that threshold, and not have to do a plan audit. And so now the fact that this is increasing just means you have a broader scope of participants that you could do this to if they're no longer employed, they're no longer contributing to the plan, and they just have a small balance on there, and it's driving those numbers up and causing you to have to get an audit.
And as we all know, audits are not fun, and pretty much anything that we can do to get below that threshold, this kind of just puts another tool in our toolbox to do that. So moving on to the next provision, and I would have to say that this is one of my favorite provisions in the Secure Act 2.0, is the expansion, or really the mandated expansion, of automatic enrollment. So it will be an obstacle for some plan sponsors, but I really do believe that anything that we could do to help people to start saving early for retirement really is the better. On that note, for any company out there that does not want to have this provision in the plan, they must get that retirement program started soon. So time is running out on that RFP process. So like I said, starting in plan years beginning after 2024, so that's 2025, there will be an expansion on that automatic enrollment mandate. So pretty much it's going to look like once an employee becomes eligible as defined by the plan document, they will be automatically enrolled in the 401k plan without having to take any action on their own. So this means that they will be set up to make contributions from their paycheck in the plan unless they opt out. So in the Secure Act 2.0, the initial automatic enrollment rate will be set at a minimum of 3% or even higher if the plan chooses, but that automatic number cannot exceed 10%. Additionally, there is a mandate that there has to be an automatic annual increase of 1% per year until a participant, the rate reaches 10%. And again, a participant can opt out of this automatic enrollment and even the automatic escalation, but it needs to be they need to make that decision. There will be a few exceptions to keep in mind, however. Plans that are in existence before 2025 will be grandfathered in and not have to use this automatic enrollment provision. Also, small businesses with 10 or fewer employees will be exempt. And also, if you are a new company and have been in existence for less than 3 years, you would be exempt from this retirement as well. But like I said, overall, it will be a little burdensome for some employers, but I really do think that this is the right decision to have these types of automatic enrollment provisions in plans. And I think the Department of Labor did a really great job to kind of push this one through.
Yeah, some caveats around automatic enrollment. It is a great provision. It drives participation. It can typically help plans pass their annual testing if they're failing, but it does add some administrative, let's just say, complexity to the plan. And as you start to see more and more plans auto-enrolled, I think it becomes even more important that the payroll provider and the record keeper can pass information back and forth, or what we call 360-degree integration, meaning that you can make a change on the payroll side and it flows through the 401k side. You can make a change on the 401k side and it flows through to the payroll side. This is the case for most large payroll companies, not all of them, but it needs to be set up properly. And plans can get away with having 180-degree integration, but the minute you add automatic enrollment, having 360 integration really just makes life a lot easier. So it's one thing to keep in mind as you're either working with clients or if you have a plan and you're thinking about doing automatic enrollment.
Yeah, Jamie, that's a great point. And where there's an opportunity for errors, especially with no integration or 180, the plan might have a history of maybe 12 months with no errors, but eventually that an error is going to happen. So that's why we always try to push everyone to get that 360 link and just to take things off your table, not have to worry about it. So moving on, in 2025, there also will be a new way to calculate long-term part-time workers eligibility. But really, basically, what it looks like, it reduces the 3-year rule that we had in the past to a new 2-year rule. So an employee needs to complete at least 500 hours, 2 years in a row to become eligible. And before the Secure Act 2.0, that number was set at 3. So pretty straightforward provision there. This is another one that I personally do like. The Secure Act introduced measures to help individuals locate their lost savings account. I know me, even when I was working in college, I'm pretty sure I was saving in a 401k plan. I would love to have a database to go in there and search for it. The Secure Act 2.0 established a searchable national database called a Retirement Savings Lost and Found, just to make it easier for people to locate and claim their unclaimed retirement funds. So it's not up and running yet. The DOL gave everyone a deadline to establish the database basically until the end of 2024. So this is another provision that I'm excited about to see what's going to roll out in 2025 with this one. And I would suggest that everyone just log in, and when it does become available, search. You never know what you might have out there. switching gears a little bit here, one of the primary goals of Secure Act 2.0 was to encourage employers who were really undecided about offering retirement benefits to their employees to take action and start adopting those retirement programs. The aim really was to create an environment where employers would feel motivated to say, hey, now's the time, and make the decision to offer these important benefits to their workforce. The act introduces improved startup tax credits to get those small businesses incentivized. These tax credits really do have the potential to cover nearly 100% of the costs associated with starting a plan, and even include some really generous tax credits for employer match portions. So the maximum tax credit is $5,000. This means that businesses can receive up to $5,000 to help cover the costs of setting up a new 401k or a new 403b plan. But really the provision that is, I believe, the most impactful is bullet point number 3 here. This is a separate tax credit on top of the $5,000 one that you would receive. So a tax credit is available for employer contributions up to $1,000 per employee for 5 years. So it phases out around 100 employees, but still that's a really big tax credit for the plan. And basically, if you do start a new plan and you have the ability to give the profit sharing or safe harbor, you could receive a dollar for dollar up to $1,000 per employee. So it could potentially be somewhere, there is the phase out, so it could be thousands and thousands of dollars that you would be receiving in a tax credit. So employers, another really interesting provision in the Secure Act, employers can now give small gifts, such as gift cards, to employees who choose to start contributing into the retirement program. And this could really serve as an incentive without breaking any IRS or ERISA rules. And we really do recommend that everyone consider using this type of option during some employee education sessions. So Jamie and I, we do focus a lot on employee education here at the firm, and it really is a part of the practice that I do especially pride myself on. So you could set it up so that every employee who attends a group meeting gets maybe a $5 Dunkin' Donuts gift card or a Starbucks gift card, or even, let's say, every employee who sets up time to talk to me or the advisor one-on-one gets a gift card. Like I said, really anything that we could do to get employees excited about the plan and to start saving early, the better. And, you know, these small incentives can really go a long way to kind of click the light bulb for that participant to start saving more for the plan.
Yeah, sometimes employees just need a little bit of a push. It is complicated. It can be a little bit intimidating, you know, depending on the employee base. If you have a white collar employee base, oftentimes they're going to be much more engaged financially. But if you have a blue collar employee base, oftentimes it can be a little bit intimidating. And so things like this, or just allowing them to meet with someone one-on-one, not in a group setting, where there's that pressure that I'm going to say something stupid. That might be the difference between walking them through and getting them enrolled so that they're contributing and not. And there is a direct link between the employee's sense of, let's just say, financial stability and their long-term job performance and satisfaction.
Definitely a correlation there, definitely. So what are plan sponsors saying about all those important provisions that we talked about earlier on in the presentation? So we really have some data on it now. A major record keeper recently surveyed over 1,000 companies and plan sponsors to see which options and provisions were really most important to them, and then also which ones were least important to them. So plan sponsors, they do have a lot on their table, as I'm sure you all know, and are really kind of focused on simplifying the plan's administration. And as you can see here with the top 3 most important provisions from the survey, they all ease in plan administration, let's say. So the most important provision for plan sponsors in the survey was eliminating some notices for eligible, not participating employees. Like we talked about before the Secure Act, even if an employee opted not to enroll into the plan, we were required to send notices to them. The Secure Act eases the burden a little bit for everyone. Self-certification of hardships. This could be a really difficult decision for someone who's sitting in HR, the head of HR, something like that. They would need to, before the Secure Act, have to verify that when an employee takes a hardship withdrawal, that it is for one of the pre-approved reasons by the Department of Labor and ERISA. Now, and a lot of times you would have to do a little bit of investigating, and it could be a little bit uncomfortable asking your employee these types of questions to verify that the hardship withdrawal was legitimate. Now, the Secure Act 2.0 allows HR to have the employees self-certify for hardship. So the employee would certify that this, in fact, was a legitimate hardship withdrawal, and HR could take their word for it. The third thing, like we talked about before, would be that mandatory IRA rollover limit. Increasing that amount from $5,000 to $7,000 was the third most important provision for plan sponsors surveyed. Now on to the three least. So the top three least important provisions from the survey was that student loan match that we talked about before. The second was that PLESA emergency savings account that you tack on top of the 401k plan. And then the third is that Roth match non-elective. So matching dollars on a Roth basis, having the ability to participant to elect that. So why did plan sponsors choose that these were the top three least important provisions? Because when you really think about it, they do require a plan amendment for a lot of them to get on the books, and they really do add some complexity to the plan that was really not there before the Secure Act 2.0. A lot of the heavy lifting really would need to be done by the payroll company. There could be some additional fees there. So likely these three provisions, if elected and you went through with the plan amendment, it would likely cost the plan sponsor more to administer the plan overall as well. So that's what we're seeing on the landscape there. Again, over 1,000 different 1,000 different plan sponsors were surveyed. Several different provisions, both mandatory and optional, really do still require guidance from the Treasury Department and the Department of Labor. But for the most part, what we've seen when talking to our record keeper vendors, a lot of them are holding off on implementing any optional provisions until they receive some necessary guidance. So like right now, like I said, we have the ability to match in Roth dollars into the plan. But a lot of the record keepers right now, if you go ask them, they don't have that built in yet. But they are kind of waiting for more guidance with the Department of Labor and Treasury before they build that into the plans. So a quick timeline. I know that we threw a lot of information out there, the provisions that we thought most important. We'll run through the timeline here just to give you a second to show you where they all kind of fit in. So in 2023, there are going to be new exclusion to early to the 10% early withdrawal penalty, things like a qualified disaster, qualified birth, or if you're deemed terminally ill, there are certain exclusions on that withdrawal penalty. We talked about in 2023, so this year, employees may self-certify hardships. This is a big win for plan sponsors, not having to do that uncomfortable verification of those hardship withdrawals. Employers may permit Roth match, like we talked about. That started this year. Removal of some notices to unenrolled participants. The really, really generous tax credits are available starting in 2023. So any new plan that gets on the books, they will be able to benefit from those generous tax credits that we talked about earlier when it comes time for them to file their taxes. 2024, with the plan amendment, employers could start matching on student loan payments. Also in 2024, that catch-up contributions must be Roth goes into effect if you do make more than $145,000. The auto cash out increases in 2024 as well that we talked about. The emergency linked savings account, that PLESA account that we talked about, goes into effect in 2024 as well. The retirement savings lost and found must be made by, what did we say, December 29, 2024. So in practical purposes, it's 2025, but it needs to be set up by that date. There are also some new exclusions to the 10% early withdrawal penalty. And then 2025, that's where we're going to see those automatic enrollment provisions kick in. So new 401k plans must required to have auto enrollment, like we said, at least 3%. There also is a new 90-day unenroll. So let's say if you're a participant and you're automatically enrolled in 2025, you have about 90 days to feel it out before you could unenroll. So you could actually pull the money out of the plan with that automatic enrollment provision. Those part-time eligibility rules kick into effect in 2025 as well. And then catch-up contributions increase for savers 60 to 63. And just as a review, that number is going from $7,500 to $10,000. So that's the timeline there. I hope everyone enjoyed the slides. We'll pause here and just see if there's any questions from the group.
All right, one came through the chat.
Sure.
They asked if we could get a copy of the slides. Yes, you will. I'll send a copy of the presentation to everyone along with the program recording once it is edited.
Great. Yeah, definitely. The slides, we didn't cover all the information on the slides, but we really created the slides as a resource for everyone to take home after today's presentation, to look at it a little bit more detailed and to just really to get to know the Secure Act 2.0. Well, we built in a little bit of time for questions today. It sounds like there's no questions from the group, so we'll give everyone back an extra 20 minutes from their day here then. But I certainly do hope that everyone enjoyed getting to know the Secure Act 2.0 a little bit more. And like I said, the slides, we built them as a resource for everyone, so we'll circulate them after today's meeting.
I'm sorry, one more just came through.
Sure.
Can you quickly summarize the optional items?
Sure. So let's go back to the timeline here. So starting in 2023, let's do it this way. This is going to be mandatory, so it's going to be in the early 10% withdrawal penalty. Employees may self-certify hardships. That's going to be written in law. Employers may permit Roth match. That's going to be an option. You're going to need to do a plan amendment for that one. Removal of some notices for unenrolled participant, that's mandatory. The small business tax credit, I guess that's optional. You have the ability to claim those tax credits or not. Employer matching of student loan payments, that's going to be another optional provision. So you're going to have to put a plan amendment in place to get that one up and running. Catch-up contributions as Roth in 2024, that's going to be mandated. The emergency, the no RMDs, that's going to be mandate. Auto cash out increase, so that's going to be optional. You are not forced to roll those participants out if you don't want to. However, that number will go from 5,000 to 7,000. The emergency linked savings account, that PLESA account that we talked about, that's also going to be an optional provision. So you're going to need to put a plan amendment in place. The retirement savings lost and found will be created. New exclusions to the 10% early withdrawal penalty, that's going to be mandated as well. Automatic enrollment, that is going to be mandated. Plans after 2025 will not have any flexibility with that option, including the auto escalation. The new 401k, 403b plans to allow 90 days to unenroll, that also is mandated. Part-time employee rule, that's going to be mandated. And the catch-up contributions for participants 60 or older, that is going to be required in law as well. So I quickly kind of went through there, but also on the slides, we did mark, so for your takeaway here, once you get the slides, we did mark the ones that are optional and which ones are not, also for your convenience. So great question.
All right, thank you, Chris. I don't see any more questions on the chat.
Well,
So I think
awesome.
maybe that will be it for today. But thank you, Chris and Jamie, for doing this program for us today. And I will send a copy of the presentation and the program recording once it's ready. Our next webinar is on July 13th with the Proactive Response Group. And this is going to be an active shooter response discussion. They're going to show us how to recognize a threat, respond, and survive. And thanks again, everyone, for joining. And please feel free to send your feedback and program suggestions to me. I'm Katie Kalmehe-Eva, or KDK for short. Thank you so much.
Thanks, everyone.
Thanks, everyone.